Good evening. This is Dwayne Lowry for the DPP Grain Desk on Sunday, January 29th. I want to talk a little bit tonight about producer outlook and conditions in a backdrop that they're going to have to face as they consider how to market both the remaining 2011 inventory and a look at 2012 production. But first, let's talk about tonight. As far as tonight is concerned, I think there are going to be a prevailing expectation going away Friday to expect some sort of price weakness. The technical crowd is kind of gearing up expecting that. The fundamental crowd really hasn't embraced the last several days of upward price movement. They really don't believe in it, or accept it. And I think that they feel that South American weather is improved, even though prices have continued to gravitate up or maintain higher levels and disappoint bearish expectations. But there's a general belief that we can't stay up. I understand that to some degree, and I think we are going to experience some sort of a correction process over the next couple of weeks. But it's going to be a sloppy and choppy trading affair. Other news looking at that we have to factor in tonight: Greece appears to be a little bit closer to having achieved some sort of a tentative deal with private bondholders here on Saturday, that they announced on Saturday. Some details still need to be worked out, but there seems to be a more optimistic mood there. So that could lead to some sort of risk-on type of mentality for the trade tonight. That might be a boost to crude oil and maybe some other commodities, maybe a boost to the stock index. So some could view the grain trade getting a boost from that. That's not an unreasonable expectation, but it's probably not the most prevailing thing involved for the grains here. Another factor look at over the weekend: Iran was expected to have a vote starting today, a debate and a vote starting today about possibly ending crude oil exports to the European Union, rather than allowing the European Union to have a 6-month transition period where they slowly cut back on existing contracts and quit making new contracts. But Iran has decided not to go ahead with that. They've delayed that vote. The UN has a group traveling to Iran, actually started today with some inspections. So there's possible that you could see some optimism that talks are resuming there. It might also be a statement about how much Iran really does fear economic problems associated with difficulty in exporting their crude. But I don't know that history says we should have a lot of faith in anything that develops over there in Iran, and it's going to continue to be an area of concern and a trouble hotspot. So I think that you have people in the grain trade generally expecting weakness. There's going to be selling on strength if it happens, but expect to be a very sloppy trade. Looking ahead and getting past tonight and looking at what producers are dealing with, I think it's important that producers, when they start talking about marketing 2012 or trying to figure out where to market the remaining 2011 inventory, they recognize that the backdrop we're dealing with now is different than we had a few years ago. We're talking about larger acreage in both corn and beans for 2012, probably some near record corn acreage for 2012, or at least record in recent history, and record since we've had a corn-bean rotation type of acreage base in the U.S. We've had periods before where we've had expectations of a larger acreage increase, and that didn't necessarily dampen price enthusiasm. But the difference then was it was felt it was absolutely necessary in order to correct a shortage of supply situation, and we couldn't afford any type of risk. Now we have an expectation for larger acreage where people are anticipating and pondering about carryouts being twice the level that we have at the end of this current old crop marketing season in corn, and a bit further build up in what is already a plentiful U.S. supply of bean stocks and a very plentiful global supply of stocks. So that part is different. We also have a different investor environment, where before, the worse the economy looked, the more the traders and global investors expected a loose monetary supply approach, which would be beneficial to commodity. They expected monies to come into commodities That helped drive land prices up, it helped drive energy prices up, and all commodities got a boost out of that. Now, as the investor looks ahead, he knows that while we may still have a period of a dovish approach from the Fed and maybe another QE3 period ahead of us, on the bigger picture, we are stabilizing U.S. economies. We're stabilizing global economies. Growth rates might be slow, but it might not be the type of environment that creates a massive printing of money type move by the world's Federal Reserve banks, some world's central banks. And I think that creates a situation where the global investor is looking for other places to go with their money other than into commodities. If they unwind that type of thinking and they eventually look for interest rates to go up, even though the Fed says it might not occur until late 13 or even late 2014, that is the next direction that we're going to be moving in, and the global investor is looking for a different approach than we've had the last couple of years. So right now, any boost we get in the commodity markets, the agricultural markets, it's going to either have to come from weather, possibly an acreage concern, but mostly it's going to have to come from weather. It could come from a spillover effect of a bump in crude oil prices. It could come from a spillover effect of still another play at buying of commodities. But now those rallies, whether they're weather-related, outside market-driven, or technical-driven, or whatever it may be, now those rallies are selling opportunities, and that's how the producer must look at them. They must see those rallies as an opportunity to find a place to make sales, not see those rallies as the beginning of a multi-month or a multi-year build in prices and a sustaining of higher prices. We've already experienced that. We're now on the other end of that bell curve, and I think that the producers need to start viewing things, searching for opportunities. We also have a situation that as carryout ideas begin to grow at what we might develop for carryout, we're going to be dealing with a lower profit structure in agriculture than what we've had the last few years. That means you can't look at an opportunity and say, well, this is not a good opportunity to make sales because it's not as much profit that's been offered to me in previous years during January, February, March, or April. I don't think we're going to get that. I think the price structure, the way the futures market is aligned, it's almost assured that you're going to have a smaller profit margin to work with, and your expectations of what is a good profit needs to be adjusted from what it has been the last couple of years. That means like DEES 12 corn, which recently got to 590 something. From in the spring of the year, if we get some weather concerns or we get some outside market things, we get back to 590 to 620, that's going to be a good price level. That'll be a good profitable level. It may not be as good as we've seen in recent years, but it may be as high as we should expect. We should see it as a reasonable expectation. It should be the upper part of parameters. So I think we need to now look at these rallies and try to find the selling opportunities and not get caught in a trap where as soon as the market goes up, we begin to immediately talk $7 or $8 corn again. I think that's a trap. And I think that that's something the producer is going to have to really overtly train himself and force himself to view it that way in 2012. This could easily be the year that your best selling opportunities, your best profit opportunities for your 2012 production occur very early in that marketing season. For the DPP Grain Desk, this has been Dwayne Lowry. Thank you.